It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades. Rick Ducat joining us here in studio to take us through the charts. And here to take us through the trades is Don Kaufman, the co-founder of Theo Trade. It's great to have you both with us for the big three today. Now, Don, I'd love to just start with a big picture thought on the market today.
You know, one of the things I'm just looking at right now happens to be just between now and the end of the week, risk is actually picking up. Specifically, I'm looking at SPX volatility. And what's interesting is just between now and Friday, and I'm talking about the Friday afternoon, which is termed the PM settlement, the volatility is expanded. So, you know, typically coming into a FOMC announcement, coming into an option expiration like this triple witching, you know, volatility is well situated. Right now, though, it's actually come up this morning and in a considerable, you know, meaningful way.
All right, and Don, I want to move right into your first trade. I was speaking to my last guest, Pete Najarian, actually about GLD. You've picked it. I think you may have dissenting opinions on where it's going. So, you know, break down your first trade for us and tell us why you picked SPDR Gold Shares ETF.
Yeah, you know what? So this first trade is actually going to be a short position specifically inside of GLD. And it's not a longer term take in gold. It's that gold in the here and now is wildly overbought. Like you need another terminology for what overbought is for gold at this point. It's absolutely parabolic to the upside. And, you know, I define, you know, parabolic to the upside, not so much through technicals, but through looking at the options market. And GLD has continually exceeded what the option market expected by a very, very wide margin in literally 4 consecutive weeks. As such, I'm going to take the other side. I think the Fed's going to come out today. I think it's well priced in. And what's going to happen is the dollar's going to rally and it's going to spin gold, okay, kind of back around, meaning that as the dollar rallies, it's going to pull gold back. That's exactly what I'm looking for. My trade is the OX17 expiration. So OX17, I'm going to buy the 337 puts, and then I'm going to sell the 332 puts against it. So it's a nice $5 wide put spread done for a $1.95 debit on the, on the day of this Fed announcement.
All right. And then, Rick, with all that said, can you walk us through the chart here for GLD?
For sure. And, you know, really pretty straightforward when you look at the breakout that Don's describing here. 316 was our repeated ceiling around this area, our light green line here. Then when the breakout happens, this is why we try to look for these repeated stopping points for price. You can see an energetic breakout when the price activity gets overwhelmed. It triggers the cascade of orders, and then the breakout ensues to the upside. I'll let you know when it stops. It's still going here so far. But 326 stood out to me as a point where we did make a bit of a low, and then we had this long lower wick extending downward here on that red candle. It fought its way right back up, though. We actually got the rather odd situation of the very narrow real body on the candle despite that long wick to the downside here. So 326 could be a supportive area to watch here. If we were to try to look forward here, we can see RSI, as Don said, very high, around the 80 region here, 79. RSI only goes up to 100. So really that would be quite a large number to consider here. Notice as well our 21-day exponential moving average in yellow. It lines up with that same 326 level that we just were discussing a moment ago. So now if we add our volume profile study and our standard deviation channel study, more emphasis on this level. Once again, our linear regression line, our line of best fit, lines up very closely. So this could be a longer term supportive area to watch out for here. But for now, volume accumulated around that 335 area, very close to Don's break even for his trade. To the upside, it's hard to say. I mean, you could try to use this channel that would project potential highs, but +1 standard deviation channel for now comes in at 357.50. Quite a stretch here, just saying where the study reads. That's what the numbers are.
Well, Rick, we appreciate you breaking down that chart for us. And Don, coming back to your next pick now, we're moving on to Caterpillar. You know, in the last month, up about 10%. Are you bullish or bearish here with this trade?
This one I'm actually bullish, and I'll tell you. So I kind of plucked this trade yesterday and this morning, and the move that I'm looking for is literally playing out as we speak. So in Caterpillar, what I'm specifically looking for is the kind of the infamous gamma squeeze. And for those of you not familiar with the gamma squeezes, very often we'll see a stock kind of approaching all-time highs. As the bell goes off in the morning, retail trade comes rushing in to buy calls. Now, as you buy calls, what it's actually doing is it's forcing the market-making firms to sell those calls and then in turn buy stock. Buying stock drives the stock a little bit higher. Again, it's what we kind of, terminology is a gamma squeeze. We're seeing exactly that kind of play out right now. Caterpillar technicals look really good to the upside. This trade, fairly short duration. It's a SEP, okay, 26. SEP 26, buying the 442.50 calls. So buying the 442.50 calls, selling the 445 call. It's just a very small 250 wide spread for a $1.10 debit, looking for this quick burst, if you will, of the gamma squeeze to the upside.
All right, and Rick, as we take a look at the charts here for Caterpillar, walk us through some of the technicals here.
Well, some levels that stand out if we were to backtrack here. This green line, 407, we can see that was a gap level all the way back here, repeated high points around these areas, a brief consolidative phase, and then that's where we bottomed out, around that general point once again. So 407 to the downside was kind of our key downside range that was established. The old resistance became new support, as is commonly the case. We can also see that in some ways, this chart is like a less advanced version of our last chart here in terms of the phase of the breakout. This is one that's right at the beginning here. You can see we had this double top type of activity near 438 at our green line here. Now price shooting to the upside here, making new highs. You can see, though, that our trend has shallowed somewhat here. We had a steeper trend line in blue, a more shallow trend line in white here. That suggests momentum could be slowing down somewhat here. You can see, though, when we look at our RSI more carefully, things are still holding on for the most part, and we are approaching that overbought area, that threshold of 70. That would generate the bullish signal. Our shorter term trend line in white here also lines up with our 21-day EMA near about 428. That could be support as well going forward here. Finally, to assess our volume situation, well, the node that we have nearest to us is right around those highs. That's where the volume kind of makes a smaller spike. Then we have our next high concentration area near about 415, 420. That lines up with some of our other indicators as well. That could be downside support. 458, though, +2 standard deviation channel. That could be a boundary to the upside.
And right now, Caterpillar trading at 447.45. So, Don, this brings us to your final trade and your final pick. Walt Disney is the last one. They had made headlines yesterday with their new 2% stake in Webtoons. But, what are your thoughts here, and what's the trade look like?
Yeah, I saw the news yesterday and looked at some of the price action. I literally thought to myself, yeah, the mouse house is about to get faded, and that basically means I'm taking a bearish position inside of Disney. Now, this trade is going to be a little bit further out in terms of duration, so I can see that inside of Disney. First of all, the underlying is starting to roll over. There's not been, though, considerable sell side activity. That's exactly what I'm going to be looking for to kind of grip hold. All right. The marketplace as a whole, well, we're talking a little bit about like economic slippage right now. The overall economy, there's some job losses going on. That's still up in the air. I think we're going to hear more out of the Fed on this one. Nevertheless, if there's questions about the economy as we turn the corner into fall, I do believe we're going to see some sell side in Disney. And really, this one's kind of ripe for the plucking over here. It has not been participating in any of the rally inside of the S&P. It's not in the tech world. It's not competing anymore against a Netflix. It's just, again, wavering, and I think that that's actually going to lead to sell side. With that sell side activity, I'm going to give myself, again, duration. I'm going to go all the way out to the Nov 21 expiration, right? So we're going all the way to November. It's like 65 days out. And we're doing that specifically because I'm saying this is not going to be a small move. This is not a small incremental move like I was looking for in Caterpillar, which is a burst to the upside. This one, this is going to be a bigger move. This is going to be buying the 110 puts, selling the 100 puts. It's a full $10 wide put spread. It's out of the money. It's for a $2 debit. As you're going to see in a moment here, Rick's probably going to show you the technicals might line up very, very nicely for this trade back to the 100 level.
All right, Rick, so do the technicals line up with that trade?
Well, I mean, just at a glance here, 100 lines up with the low point of this gap. That's the obvious first thing that you would probably point out from a technical perspective. But we've got a ways to go here. That's kind of a rough road here for the happiest place on earth, unfortunately. But 115, our green line here, an old high point, subsequent high points and stopping points, a low point here as well. And then that's about where we're trying to hold on now. It also lines up with our trend line here. You could draw this more triangular shaping looking trend line here, a symmetrical triangle shape going across the highs and the lows. We are in an increasingly narrowing range. We're getting close to these boundaries. What you'd want to be looking for would be a breakout either to the upside or the downside here beyond those lines. That point here, right about 115, right about where we have hit our lows recently here. To the upside, maybe 119 would be a place to start looking here. High point, low point, high point, repeated high points here, a bit beyond the boundaries of our triangle shape though. To look a little bit closer here, we can see RSI, our measure of momentum here, looking a little bit, range bound here, kind of matching price. Clustered moving averages suggest weak trend directionality here as well. So not really much of a trend at this point here. That can change very quickly, and we can see if we were to start moving lower, 111 is our point of control here for the volume profile. That's where things really start to dry up, and then guess where it picks up again? Right around 100. So that would be some things that I would point out as well for this particular stock.
Right now trading about 116.25 for Walt Disney, and underperforming the market, only up about 4% year to date for Disney. But Don, I want to thank you for being with us for Big Three today. Don Kaufman, the co-founder of TheoTrade, and Rick, of course, thank you, Rick Ducat, for breaking down all of those technicals for us in the charts.